at the end of the day, there's an element of luck and timing to this that, if you finished up a project in 2021 at peak pricing, you look like a god, you look brilliant. And, if you finish one up now, maybe you look like a donkey.
Welcome to the Lead Sponsor, where we bring you exclusive access to the most successful and sought-after real estate syndication sponsors in the industry. Join us as we dive deep into the stories, strategies, struggles, and secrets of these elite professionals who are changing the game in commercial real estate investing. Whether you're an active sponsor looking to take your business to the next level, or a passive investor looking for the best operators in the country, the Lead Sponsor podcast is for you. And now, your host, David T. Robinson.
Hey guys, David Robinson here. Welcome to another episode of the Lead Sponsor podcast. I'm excited to have Ryan Tobias with me. Ryan, how you doing today?
I'm great, David. How are you?
So good. Excited to get into our conversation today, learn a little bit more about your business and what you do. For our listeners, Ryan is a managing partner of Jackson Dearborn Partners. He oversees all elements of JDP business, including acquisitions, site selection, fundraising, investor relations. Jackson Dearborn is focused on multifamily opportunity zones. Ryan has had 17 years experience and has worked on over $1 billion in transactional real estate and has developed or acquired over $800 million in student housing and multifamily real estate. Jackson Dearborn Partners has acquired a total of 21 projects in about $1.5 million in total acquisition value, give or take. So Ryan, that's a very brief bio, very brief explanation of what your business is all about. If you can, let's dive into a little bit more detail about Jackson Dearborn Partners and how you guys are structured today and what you guys focus on.
Yeah, sure. I appreciate that intro. We're largely focused on ground up development. We've been around for about 9 years now. We got our start doing more acquisition, value add, multifamily student housing. And over time, that's really segued into a real focus on ground up development. We've done a handful of student housing projects in that space, but we have been more focused the last few years on multifamily. Opportunity zones, which is sort of a tax advantage program that some of your listeners may or may not be aware of, are kind of our main area of focus. We're an early mover in the opportunity zone development space, and we've really used that as a catalyst for growth. It's a great program, the long-term hold program that basically eliminates capital gains tax if you hold the asset for more than 10 years. A little more complicated than that, and I can go into that in more detail if you like, but that's a simple answer there. And we're mostly active kind of here in the Midwest. We're based in Chicago, and then out in Colorado and Arizona. We have an affiliated general contractor called Sub 4 that builds all our projects and only builds for us. They have offices in Illinois, Colorado, and Arizona, and that's really where our growth is expected. We'd love to get a foothold in the Southeast. That's something we have on the books here for 2023 or 2024. But for now, it's kind of those three regions of the country.
Love it. From a key personnel perspective, who's involved as far as partners and principals, and then maybe some key personnel in your business? How are things structured?
Absolutely. So there's myself and Chris Saunders. My partner is kind of the other managing partner at JDP. Chris and I have known each other for 16 years. We worked together, and we'll go into this a little later, but when I was on the brokerage side of the business, he was a principal acquiring properties. We started that relationship. And then I've got two partners that we started a brokerage company together who are also partners at JDP. And then over time, we're an organization, we're a relatively small, relatively flat organization where the goal for us is for everybody to be a partner. So, most of the senior personnel over here have a stake in the company, are very vested, been with us a long time, and hopefully will be with us for a lot longer time, because we try to make it a setup where everyone's rowing the same boat. We're all in this together, and we can really build something special.
And do you guys focus as or operate as a fund, or do you acquire one-off deals with them being development deals? Is it more one-off than the fund model? How are things structured from that perspective?
Yeah, for the most part, it's one-off. We've structured most deals deal by deal, and raised equity, either done joint venture partnerships or raised equity individually at the deal level. We've kicked around doing a fund for a long period of time, and it's something that we may well do at some point. We're still relatively young, relatively small firm, and continuing to build track record to be able to point to if that's something we want to go down the road on. We did do a small co-GP fund this past year, which is exciting. Kind of our first sort of, it's a smaller fund vehicle, but nonetheless a commingled multi-asset fund. So that's something that we did this past year. We may do again, but largely deal by deal. Investors that invest with us kind of like that aspect. It can really wrap their arms around a particular project, look at the underwriting, rather than just hand you a check and cross your fingers and trust you to go and find their assets and make it work for you.
Yeah, makes a lot of sense. You guys are based out of Chicago. Are you a remote firm? Is everyone in-house? How are you guys structured from an actual physical location perspective?
Yeah, so we've always kind of had this multi-office, semi kind of remote type of structure, even pre-pandemic, and just sort of by necessity. So the primary office is in Chicago, but we've got an office, including the construction team, that's actually down in Champaign, Illinois. Mentioned that we have the construction guys in Denver/Colorado Springs, and then in Phoenix, Scottsdale. And then I actually we have a satellite office in Ann Arbor, Michigan, which I relocated to about 8 years ago now. And so we always kind of had this sort of hub and spoke kind of model. And it used to be maybe a little more travel than it is necessary these days, that technology like we're using right now has allowed it to be even tighter knit. But we are we're a little old school. We're pretty much an in-office type of a shop. We were very collaborative, a lot of camaraderie here, open office setups. And so, we like people to be around when they can be. Of course, we're very flexible, but, we're not a centralized location. We're pretty decentralized, and that, the pandemic kind of was business as usual for us.
Yeah, makes sense. And you mentioned that your main focus today is on ground up development. The type of deals that you're putting together, are you looking to exit the development deals after stabilization, during lease up, after entitlement? What do those type of deals look like? Or do you refinance and hold longer term? What does that look like for you?
Sure. So generally speaking, we're more of a long-term holder than just sort of a merchant developer, as you might call it. That's kind of, especially in development. I think development's hard. It takes a long time. It's just an arduous process going through entitlements, construction, and all that. And obviously, there's a nice kind of cash out and a promote to be hit if you can sell quickly. But again, we're a relatively young shop. The idea of just kind of holding deals longer term always appealed to us. Especially after you put in so much work. The Opportunity Zone program, which is so many of our development deals, almost forces you to hold the asset 10 plus years. You don't really have to, but for maximum tax benefits, you're going to be holding it. So that kind of fit with our ethos. That being said, we do have some ground up development deals that we've got a little more of a short-term focus on, a 3 to 5 year build, stabilize, and sell. We'll see. Of course, market conditions sort of dictate that, and that model in today's environment is a lot more challenging than it was a few years ago. If cap rates are 3.5%, then and you projected a 5 or 6 cap exit, you take the money and run. And it's the opposite. You might be looking at more refinance and hold, and you just have to be nimble and flexible and opportunistic. As a business plan may shift a little bit with the changing economic tides.
Yeah. Well, I appreciate you giving us an overview of your business. I think we've got a pretty clear understanding of what you guys focus on, and we'll dive into a little bit more detail and maybe even discuss one of the projects that you've worked on recently. But I want to back up and I want to talk about your own personal journey. You have a background in brokerage, but I even want to go back a little bit further than that. Let's go back to your last formal education, and let's bring things forward from there.
Sure. Okay. Yeah. So I was the kid, went to college and had no idea what I wanted to do. I think I wanted to go to college and have some fun and figure it out along the way, which I certainly did. I don't know how much I figured out along the way, but I certainly had some fun. So in that journey, I ended up I went to the University of Michigan, and part of that, I got involved in some volunteer work in the city of Detroit, and I kind of was going down into Detroit fairly regularly. And in Detroit, which is it's somewhat of a downtrodden city, but it's got some amazing history and legacy to it. It's got some amazing architecture and a built environment, and that really kind of fascinated me. Just the historic buildings down there, architecture, urban planning and design, and that sort of thing really was my kind of first sort of passion in the real estate space. And so I first thought I might want to be an architect. Turns out that's really hard and requires a lot of work and a lot of design skills and expertise that I just don't have. So then I thought about urban planning, and then that also seemed kind of hard. And then real estate development was kind of the idea of being able to be adjacent to those fields and be sort of a doer in that space and work with those professionals to bring a project to life. And that was what really got me interested in real estate. Of course, I had no background in that, and I came out of school and just decided, I tried to get a number of development jobs, couldn't, and needed to get my foot in the door in real estate. And so I took a brokerage job with a couple of guys who are still my partners today, in Chicago. And the idea there was go learn the business a little bit, make a few bucks, navigate the waters, and ultimately try to, get into the real estate aspect that I wanted to be, which took a lot longer than I thought, but I kind of have found my way there. So I was in brokerage for a number of years. I was with a company called Marcus & Millichap at that time. And then my two partners and I, we left that shop. We actually went to another shop for a brief period of time. And we started another company, our own brokerage company called Triad Real Estate Partners in 2010, which is still around today. And I'm still a part of that organization. And then in 2014, we started Jackson Dearborn Partners. Sean and Sean didn't necessarily share my passion for development as much, although they've come around on it. But we all wanted to be on the principal side of the business, and that felt like more of a long-term sort of wealth building avenue than transactional real estate brokerage, which can be really lucrative, but is a hamster wheel. And so we started JDP, and that, like, as I said at the outset here, has been a kind of an evolving business that has largely come around to primarily ground up development. And now I'm lucky enough to be working on some of the projects that I always wanted to. My 21-year-old self wanted to do. Took me 15 years or so to get around to it, but we got there. And so that's been really rewarding. It's not everything I thought maybe it would be. It's harder. But it is rewarding, and I do love the work.
I'd like to hear about your transition from brokerage into moving to the other side of the aisle and getting in on the ownership side and the principal side of things. There's plenty of our listeners that are in the brokerage space that have goals to move to the other side. It can be more challenging than just saying that that's what you want to do, especially when you've become accustomed to the type of income that's possible on the brokerage side. And so give us a little bit of insight into what that transition looked like for you, and maybe some advice for someone who's, wanting to do the same thing.
Yeah. So, it's a great point. I think, brokerage is I think one of the best ways to get into this business. It's a relatively low, to be honest with you, relatively low barrier to entry type of space. Get your real estate license, work really hard, and identify a market, and you can have success. And it can be pretty lucrative, especially when the market has been running like it was the last few years up until maybe last 6 or 9 months or so. But it is an endless grind, and you're only as good as your last deal. And there are some downsides to it. So you're right. A lot of folks I know have aspirations to invest and to be more on the principal side, and either a small way or a big way or completely over the years. It's definitely different, and a lot harder. Like when we underwrite a deal on the brokerage side, it's a pretty quick exercise. I mean, it's not to say that we don't get into the weeds. We do, but if it's going to be your own money and potentially millions or tens of millions of some other investors' money, it's a little different ballgame. I mean, that risk level and the depth that we go into to do due diligence and underwrite these deals is really deep. It's just a lot more responsibility and a lot more difficult than brokerage. Not to say brokerage doesn't have its own challenges, but I recommend folks start small, whether that's being a small piece of a larger deal. Sometimes that could be a small co-GP piece or even an LP piece on a larger deal, or do something small on your own, a 3 flat or a 6 flat or a 10 unit or whatever it is in your particular market that you can do yourself or with a couple of buddies to kind of get the flavor of that. And then that's a good way to start. And then from there, don't be afraid, and the real money is to grow and scale and to do bigger deals. And eventually, and sometimes not even eventually, the bigger deals aren't that much harder and sometimes easier than the smaller deals. So after you get, a couple deals under your belt, swing for the fences.
Looking back on your experience in that transition, how did it play out for you? What were the steps you took, or what did it look like for you to make the transition? Was it pretty abrupt? Was it a gradual process?
Yeah, no, it was a more gradual process. I mean, looking back though, if you think about lessons learned, I probably would have gone. It's easy to say now looking back because market. Real estate, the market is just so timing based, right? I mean, it's better to be lucky than good sometimes from a timing perspective. And so obviously looking back, you heard my timeline earlier. We started this company in 2014. If we had put all our chips in the table and done a lot more deals on the acquisition side or the development side, 14, 15, 16, 17, it was hard to mess up in multifamily, at least, from there to now. And we didn't. We were dabbling a little more at that point, and we didn't really start to ramp up until 17, and we didn't really start to ramp up until 19. And so if I could go back in time, I certainly would have done that. But we did a few deals, and those first few years, we're only doing a deal or two a year, and then as we started to scale up, when the market kind of gave us some tailwind there too. It was pretty clear in 18 and 19 that there was a lot of capital in multifamily. Rent growth was really solid in the markets that we were in. This is before even the kind of post-COVID massive tailwinds that came in. But the fundamentals were just really, really solid. And so we really started to ramp up then. And but if I go back in time, I would have done more and done it sooner.
Yeah. And were you still heavily involved? You started JDP in 2014, but you still had the brokerage business, the Triad Real Estate Partners, if I understood that correctly. Were you still heavily involved in brokerage when you started JDP? And was it like, hey, we're doing this on the side with a couple partners, but my main income source is brokerage business?
That's right. Yeah, that's how it first started out. In those early days in 14, 15, and then it transitioned over, because at a certain point you can't, it's just, there's not enough time in the day. And, especially if you're going to do ground up development, I mean, it's a full-time job and needs your full attention. And then also, from a brokerage standpoint, it was the same thing. If you're going to actually do that job, I mean, your clients need, you need to be focused on that job, and you need to give your clients full attention. You can't have conflicts of interest. And so, that became a situation where we needed to start passing off those relationships. We hired some younger guys to come up underneath, start to take those relationships on. And so, we're not at conflict with on either side of the business, or, just running out of time in the day to get that stuff done. But, it took time. And again, you look back on a million things, and we could have, we could have brought more guys on sooner and really handed that off more and whatnot. But we did the best we could at the time, and, it all worked out.
Has the brokerage business, has being a principal and an owner or involved in the brokerage business supported the acquisitions? And have you integrated the two in any form, or are they pretty separate?
No, I mean, we kind of keep a Chinese wall up between them, for a number of different reasons. But the overlap in those two businesses is very minimal. There's a very rare circumstance where there is a deal that the brokerage company has that would be of interest on the principal side, and we have to be very careful in the way that we handle that, right? I mean, we need to make sure that we're not, if the brokerage company is representing a seller, they're getting the absolute, best price and terms from a buyer and whatnot. So we haven't, that hasn't, there has been times where there's a possibility that there could be overlap, but then there never has been. And it's somewhat intentional and just trying to keep everything above board. So we don't. I know there's a lot of groups out there that find a way to probably make 1 + 1 = 3 a little better there, and can still do it in a way that make sure you're doing best practices and keeping the clients first on the brokerage side and whatnot. We just have felt better about keeping it really separate. And not to say there's not some synergies there and whatnot, but it just it's a sticky line to walk.
When you and your partners decided to start JDP, what was that process like? I believe the partners, you and at least Chris, were working together in the brokerage business. Is that correct? Or he was a client of yours, and then you guys?
Yeah, he was a
JDP
client
together?
of ours going back into the mid 2000s, and then and then Sean, my two partners at Triad and also at JDP. I don't know, like probably, I don't know, maybe there's, most companies are like this, maybe they're not, but honestly, it wasn't, the initial concept wasn't like we sat down, wrote a business plan and said, this is exactly what we're going to do. The initial concept was, we're just going to invest in some deals. We're going to buy some deals. And this is the entity and brand that we're going to do it under. And we didn't give it a whole lot of thought. The Jackson Dearborn name comes from the fact that our office at that time was at the corner of Jackson and Dearborn in Chicago. We've since moved from there years ago, so it doesn't even make any sense anymore. But we, it wasn't this super dedicated business plan to doing exactly this one thing. Now, over time, that's what it's evolved to, and we've sat down and hammered out exactly what we want out of this, and we do so on a yearly basis, and we could do a better job of it, but we certainly try to. But at the time, it was more like, let's buy some deals, like, that simple, quote unquote. And And then, it's just evolved and matured a lot since then. And looking back, it's almost laughable at the beginning. But and again, there's a thing, and this is 2014. I mean, I was just looking back at this deal that we bought at that time period. And granted, it was a very tertiary market, but it's an institutionally managed deal. And it was it was 80 units, and it was a true 10 cap on trailing 12. And which seems like laughable now. I mean,
Right.
and it was, and then we've run it at better than that. I mean, it's just, that was what was available at that time. We're still kind of coming off of the GFC, and so it was like we need to be in the mix. We need to to get into some assets, and so we did.
Yeah, love it. Well, I think this has been great. It's interesting. It's always interesting to hear how businesses evolve. And it seems that it's more common than not to have them evolve similar to the way that you guys have evolved. Partners starting out, deciding, hey, let's team up, let's take down a deal. Oh man, we enjoyed working together. That deal worked out well. Let's do another. And then all of a sudden it starts to scale from there. And then it becomes a lot more intentional and a lot more focused over time. And it seems that that's exactly what you guys have done. I want to transition a little bit here and talk about a case study, give our listeners a taste for what kind of deals you guys do and how they're structured. So we've got this Avian, the Opportunity Zone deal in Colorado Springs, a ground up multifamily development deal. If you can, just describe the project for us, and let's start there.
Sure. Yeah. So that's one, I wanted to chat about a little bit, just because it's, we get to do a lot of projects, and the candid truth is sometimes you do in multifamily, we do a mix of urban infill stuff that have a little more of a, bespoke design to them. And we do more traditional kind of garden style type communities, have some build for rent concepts in them sometimes, but where the architecture is a little more plug and play. It's a little more mundane, and to be honest, those deals can be they can be more lucrative and take a shorter amount of time to get off the ground, things like that. But the fun ones to work on, what I like to do, and really what most of us here like to do, are these more unique urban infill projects that you get to kind of reimagine a site and work with an architect and design team to create something just totally cool and new. And the Avian project in Colorado Springs, is one of those. And it's one of the ones that we got to work with a great design team. That's Kephart Architects out of Denver, great shop. It was an old, it was basically an art supply store. I forget what it was before that, but it had been around for a long time, that the owner kind of wanted to sell, but he had a timeline. He needed time to relocate his shop. There was some moving parts there. It needed some finesse. There's an old single-story apartment building that was part of a larger complex, and we kind of found a way to work with the ownership group to split those apart. I think, if I remember correctly, I actually I cold called the owner of that site. We knew we needed that site to kind of get enough scale to make it work, and he had a British Virgin Islands cell phone number. And I caught him down there on his cell. I don't know how we got that phone number. It was a luck or something. And I just cold called him, and I'm like, we'd want to buy your site. And he was like, well, people call. It's, people have reached out. We're not interested or whatever. And I'm like, well, listen, here's the thing. I want to buy basically half of your property for what you paid for the whole thing, a couple years ago. And he's like, well, all right, you got my interest. We'll talk, but I knew that we could make it work because of what we were doing there. And so we were able to kind of break that piece off. And a lot of folks, I think, had tried and they weren't able to do it. And it worked out. And so we have about 48,000 square feet there. We're doing it's one level of undergrade parking, a 2-story podium above that, 4-story stick construction above that. It's 169 units. And we wanted to try to set the building apart a little bit from some of the competition, and so much of what you see, what I just described, as sort of 1 or 2-story podium, 4 to 5 stories stick, is kind of like your most common infill. medium density type multifamily, and people give it a bad rap sometimes because their boxes, they look a lot alike. There's only so much articulation you can do with that wood frame architecture on top. But we designed this cool concept of it's got a little more of a, it's got this center jewel box entryway that's 2 stories high. And it's got a more of a hotel hospitality entrance and feel to it. And then it leads up into the rooftop amenities on the top of floor 2, which is a pool, which is basically like a giant spa, which in Colorado, you're going to be looking out to the west over Pikes Peak and the mountains there. And, we just think it's going to be amazing. It sets it apart a little bit from some of the competition that's kind of doing all the same thing. Although there's some other great projects in that market too. Graystar's got a couple of awesome projects, Widener, a local shop as well. So there is other good stuff, but that's been fun. And it's an opportunity zone project. We capitalized that deal, with a single qualified opportunity zone fund that we syndicated from high net worth family office type capital, and broke ground on that. Let's see, what was that, about mid 2022? So we're just about up with done with the underground parking garage component. We're just about up to grade almost here in the next few weeks, and then and start really more vertical construction. So it's been an adventure. And one of the ones, probably the one right now that I'm most excited to see come to reality.
You started in mid 2022, so
Mm-hmm.
I mean, basically, almost a year ago. When did you start the conversations to acquire the different parcels?
Yeah, good question. So 3.5 years ago or so, I guess, something along those lines. So.
Mhm.
Yeah, in Colorado Springs, which is at least in our downtown area, is a relatively straightforward entitlement and zoning process there. We were going for the most part by right. They have a TIF program down there that we applied for and were granted, but it's relatively straightforward. It's not ultra competitive. It's a great program. They're very kind of pro business, pro development down there. The folks at the city and downtown Colorado Springs partnership are amazing to work with, but it still takes, anywhere from 15 to 18 months to kind of get through that, get construction drawings done. And so, somewhere around 2 years before you're ready to go. And it's hard to move it much faster than that. And that's the thing with development. And the tough part is I think we've seen with interest rates moving and costs and whatnot, is that challenge of development, there's a million challenges, but like you start a project under a certain conception. Our budget unfortunately moved, way up during our pre-development process because this is right from, COVID through 2021 and into 2022 when inflation was just wild and construction costs just ran rampant. Is that you make a bunch of assumptions and then you're hoping they're right 5 years down the road,
Right.
that's a tough crystal ball. And sometimes things really work out for you and hopefully rent growth is, significant, but, guessing interest rates 5 years from now, and therefore cap rates and that sort of thing is impossible. And so you just have to make the best guesses you can. And I think that we as developers like to think we're, pretty smart about that. We manage risk. We're looking at, forecast and the growth of a market and capital flows and making a wise investment decision. But the truth is that at the end of the day, there's an element of luck and timing to this that, if you finished up a project in 2021 at peak pricing, you look like a god, you look brilliant. And, if you finish one up now, maybe you look like a donkey. And that there's nothing wrong with either of those. It's just sometimes that's the way it goes. The Opportunity Zone program allows us to kind of look through a long-term lens, just get the property refinanced. If you're in a good market, you hold on to a property long enough, like you're going to you should do pretty well on it. And that's kind of the goal with this project and most of what we do.
Can you shed just a high level light on opportunity zones for those of us that are less familiar with them? What is the benefit to working inside of that structure, and from both a principal side and also from an investor side?
Sure. So, in short, the Opportunity Zone program was part of the 2017 Tax Act. Really kind of came around in 2018. Final regs were done in 2019. There was a couple different provisions about it that did basically a reduction of your capital gains tax. Those may get extended, but for now, I'll focus on kind of what it looks like today. Today, what it is, if you have a capital gain from a sale of anything, real estate, stock, any sort of anything that you'd have a long or short-term capital gains tax owed or taxable event on, you can invest in an opportunity zone within 6 months. And that defers your capital gains tax that you owed until 2026. And so you wouldn't have to pay anything today. You will have a tax bill coming in April of 2027 or whenever you file taxes, but you get to delay it. And then the bigger thing is that if you hold that asset for 10 years, say you had $1 million gain that you invest, you hold that asset for 10 plus years, you're not going to owe any additional cap gains on that. That $1 million turns into hopefully $2 or $3 million. You won't owe anything on that delta. And additionally, and this gets, you hear it a little more now, but in the early days of the program, this was getting absolutely no love whatsoever. There's no depreciation recapture either. So in real estate, depreciation is the big reason you invest. It helps offset income from that asset or anything that you have. It passes through to our investors. We do cost segs and accelerated depreciation on these assets, so it's pretty substantial. Usually on the back end, when you sell the asset, people talk about depreciation like it's this unbelievable thing, and it is, but there's a thing called depreciation recapture. You're still going to owe it on the back end. In these OZ deals, you don't, and that's a huge deal. So you're getting substantial tax benefits, especially in those early years of the cost seg study where you're pushing through a lot of depreciation. You're not going to owe anything on the back end. So for certain investors, ultra high net worth, family offices, folks, and then we have a lot of investors who are in like hedge funds. We have short-term capital gains, like every minute, every day, whatever. It can make a lot of sense. Long-term, sort of very tax favorable wealth preservation strategy.
Are there challenges, hoops that you have to jump through that are onerous in working through the Opportunity Zone program?
Yeah, I think it's one of those things that's a little bit intimidating because people tend to lump it in with, say, low-income housing tax credits or new market tax credits or things like that are a lot more arduous. OZ is really not that challenging, and that legislation may change, and perhaps it should, to increase some of the reporting and application type requirements. But as it stands, there's a published list of the qualified opportunity zone tracks that are out there. You can pull it up on the map. There's a number of them out there. Nova Grodak has a great one. And if you do a project in those markets, you have to essentially double the basis in that project. So it's mostly ground up development or very, very significant renovation rehab. So it's meant to, have real dollars spent. It's not just, acquiring an existing asset. And if you do that and it's in a qualified census tract, there's tests that are performed twice a year, but they're pretty straightforward. It's a form. And then there's a form that's filled out for your taxes. And we pass those down to the investors as well. But it's really not, you have a halfway decent CPA on your team. It's not overly complex, nothing like the tax credit programs and whatnot. So, if it's something you're thinking about, highly recommend taking a look at it. It's not overly burdensome, and there's some great professionals out there, tax attorneys, just real estate attorneys and CPAs that can help guide you through the process.
Thanks for going into some detail on that. I appreciate it. I want to tie a bow on Avian. The timeline, you are just finishing up the underground and I believe the podium, you said. We're recording here mid-February 2023. So you've been, actually under construction for a little under a year now. What's the timeline look like on this progress to completion, and what's the game plan moving forward?
Yeah, so that's a spring of 2024 completion date. You'll be in the end of the day, it'll be about 2 years build. But as you can see, and I think we've now been underway for like 9 months or so. I could be a mistake on that, but so it's so much of that though is, especially when you got a level of underground parking. I mean, the site work, utility work, level of underground parking just takes up so much more time. Once we get the podium done, and we'll be, hopefully pouring that here over the next month or two, and go vertical with the stick, that stuff goes up that's just much more quick. And so we should be more or less on time as far as that project is concerned, give or take probably 30 days, and on budget, hopefully, fingers crossed. It's been one thing that positive in the last 6 to 9 months is that material costs, for most categories, still going up a touch. Some are down like lumber, but it's kind of rampant cost increases have really slowed down. So that's a little bit easier to manage. And then, we'll be kicking off leasing in spring of next year, and fingers crossed the market's robust, and we'll have a quick and successful lease up.
We didn't talk about the actual units themselves, but what's the makeup of the units, and then who's your ideal tenant?
Yes, it's studios, ones and twos, kind of your typical sort of urban footprint type of unit mix. It's largely geared to kind of young professionals, some empty nester type things. I mean, the story in downtown Colorado Springs is one of a submarket that is a little behind the times, and sort of the urban renaissance has been going on in a lot of markets for the last 20 some years. I mean, it was always a nice community down there, but not as active as it could be. And that's really been changing a lot. There's a large local group that's invested a ton of money in doing some new projects. They put up a lot of money into the new Olympic Museum down there. There's the switchbacks of the soccer team built a brand new stadium down there in the market. And there's just an incredible amount of positive momentum. And Colorado is just, it's a great place to be. It's a high, quality of life, quality of living type of place. And in this new world that we're in, this paradigm of remote work and living where you want to be, there's a lot of great jobs in that market on its own. A lot of great employers. It's kind of a military town, but there's a lot of contractors, a lot of tech-based contractors that are there. But there's also just a lot of folks that, want to be by the mountains, want to have a great sort of outdoor lifestyle, that are working a job in New York or San Francisco or LA or Dallas or anywhere else, and just choosing to live in the Springs because it's a cool place to be. And so I think there will be a lot of the folks in the building that will fit that description. But I'm excited to see how it comes together.
Yeah. Well, it sounds like a great project, and I appreciate you going into some detail on that. Well, look, I've enjoyed our conversation thus far, and I want to be respectful of your time and start winding down here, but got a few final questions for you. The first one, which I know I'm going to say in advance, I know you don't have a crystal ball. That being said, I'm interested in what your predictions for the real estate market over the next 12 months look like.
Oh man, that's a pretty broad question. Yeah, the obvious answer is I have no idea whatsoever. I mean, and it changes, I feel like, day to day. I mean, we all, in our business, we're all tracking, watching the CPI print and unemployment, and following the 10-year treasury and SOFR on a daily or even hourly basis sometimes, and keeping track of our own submarkets, which is, real estate is still a very localized and submarket specific business, and there are markets that will continue to just run and be exceptional, and those that will come and go, and those will just be steady Eddie. If I had to guess right now, it's, I don't know, it's an economy that and I'm no macroeconomist, but that I cannot put my finger on. And I'm not sure which way is up. And when I see the numbers, unemployment at record lows and I just can't put it all together. So if I had to guess, I think that we are probably in the next 12 months entering a time of continued uncertainty, but kind of just bumping along around where we're at right now, which is to say, I see the Fed doing maybe another couple raises, but not really hitting the gas in that department. The cuts that we had hoped might come later this year might get pushed off. And I think you see sort of, I don't know if stability is the right word, but I just don't see, I don't see a crash, but I don't see a surge. I just see kind of a bump along for the next 12 months would be my best guess. Somewhere roughly where we've been the last 90 days. Yeah. That's my best guess.
What's been the most challenging part of growing your business to the point it's at today?
Well, it's always a new challenge. There's always, we're fortunate that we're largely in multifamily real estate. We have student housing as well, which student had a rough patch for a minute and then has come back really strong. But, we're not in, office right now, for example, we're not in that, but we all read the headlines and imagine that you're facing a lot of headwinds. I think that for us, it's putting, it's putting systems in place, getting the right personnel in place, scaling without overstepping and having the right team in place to be able to handle the amount of business that you have, and then being liquid enough, flexible enough to continue to adjust to the challenges that are going to come because they just change. There was a time period there where interest rates were almost zero and capital was flowing like crazy. Now it's like the opposite. But at that time when you had that part of the component, you had construction costs that were escalating at a rate that no one had ever seen before. And you had to kind of you were spending time putting those fires out. Now you have some more stability in that market, but the capital markets are still a real challenge. So it's going to change year in and year out, and you got to adapt on the vine. And we've largely been successful at that. Again, hindsight's 2020, but keep yourself nimble, keep a good team in place, stay liquid when you can, and just be ready for the next challenge.
I know you guys run a pretty lean and mean team. That being said, outside of the principals and partners in the company, what's the most critical role in your business today and why?
Oh gosh, that's a great question. That's another thing that ebbs and flows. I'm really lucky that the team members that we have are like family to us. They're an extension of everything that we do. They're people that I trust implicitly with any task, and they're really capable. And so again, it just, not to cop out on that, but it ebbs and flows at what becomes really, really important. Coming up in tax time, one of our guys is a CPA. I don't know what we do without him as we come up here coming up on K1 season here. And, he certainly earns his money then. And in a lot of ways throughout the rest of the year too, but this is his Super Bowl. On the development side, I've got a guy who's kind of my right-hand man who will step in on anything and step up to the challenge he'll do a neighborhood meeting where, if we need to, if there's going to be torches and pitchforks, and, he's there for it. And the list goes on, but everybody plays a really important role. And, there are days where everybody, everyone has a day where they're the MVP. That's for sure.
Yeah. Love it. Well, look, this has been an excellent conversation. I've really enjoyed hearing about Jackson Dearborn Partners, how you guys are structured, what you guys focus on, and your own personal journey from the brokerage world and the transition into the the ownership side of things, and how your business sort of naturally progressed over time. And then your deal there in Colorado, the ground up development deal, Avian there in Colorado Springs. I appreciate the time that you spent with us today and sharing your journey with us. Before I let you go, what's the best way for our listeners to connect with you and learn more about what you have going on?
Yeah, sure. And I really appreciate you having me on here. To be fair, I thought I was getting on with the Admiral today, but I'll settle for this.
I'm the short light version of the Admiral.
Yeah, right. I'm like, who's this guy? I thought I was going to ask you some questions about the Spurs. But yeah, so our website's the best way, jacksondearborn.com. My email address is on there. I think my number's on there too. There's the rest of our contact information for our whole team, and see our portfolio, what we've got upcoming, deals where there might be an opportunity to invest. So jacksondearborn.com. I'm on Twitter. I don't do a great job of that, but I do try to post there from time to time. It's Ryan _Tobias _JDP as well. Yeah, feel free to reach out. Appreciate everyone tuning in.
Well, Ryan, thanks for coming on. For all of you listening, if you enjoyed the conversation with Ryan today, go down into the show notes right now, click on one of those links and connect with Ryan and his team. Ryan, again, an honor to have you on the show. Thanks for sharing your journey with us, and I look forward to staying in touch down the road.
Sounds good. Thanks so much, David.
Hey there, before you go, I just want to thank you for listening to the show. We hope you enjoyed the episode today, and if you did, please, please, please take a moment to rate and review the show. Those ratings and reviews help us to attract the very best guests, and we want to bring you the best guests in the industry. Also, we're active on social media, so be sure to follow us on YouTube, LinkedIn, Facebook, Twitter, and Instagram. There you can stay connected with us and up to date on all of our latest content. Lastly, don't forget to check out our website, theleadsponsor.com. We've got some free trainings and resources there that will help you grow as a leader and an investor. Again, thank you so much for supporting the show. We'll see you next week.